Hello everyone, Mr. Lipchick here, and our topic for this block of instruction will be banking. Banking is a relatively new institution. A bank is an institution for receiving, keeping, and lending money. Before the Civil War, the institution of banking was informal, with merchants storing money in safes for customers, like the early strong box that you see to the right. Well before those times, well before modern times, people simply buried their money. That is why in Europe you could frequently find old earthen jars buried deep in the ground that are filled with old Roman coins. Deposits were not secure in that there was no insurance, and customers were sometimes cheated or banks were robbed. If a bank was robbed in the old days, then too bad. You were just out of your money. Two views of banking emerged in the United States after the Revolution. The Federalists, led by Alexander Hamilton, believed that a centralized banking system was necessary for a strong economy. Hamilton proposed that a national bank would issue a single currency for the entire nation, manage federal funds, and monitor other banks throughout the U.S. The AntiFederalists, led by Thomas Jefferson, supported a decentralized banking system. The states would have the power to establish and regulate banks within their borders. The first bank of the United States. The Federalists succeeded in creating the first bank of the United States in 1791. Was granted a 22-year charter to operate, and it would issue representative money backed by gold and silver. It supervised state-chartered banks. Critics of the bank argued that it would only make loans to the rich. And the bank's charter ran out in 1811, and it was not renewed. One of the reasons it was not renewed was that Hamilton, who was a champion of the banks, was killed in a duel with Aaron Burr, the Vice President of the United States, and as a result, the bank system crumbled. The second bank of the U.S. After the first bank of the U.S. closed, a period of chaos in banking ensued, with states chartering banks that issued unreliable currency. In 1816, Congress created the Second Bank of the United States. The Second Bank slowly managed to restore public confidence in banking. Then came what is known as the free banking era. The free banking era was ushered in when President Andrew Jackson refused to renew the Second Bank in 1832. Jackson was very much afraid of centralized power. Different currencies caused frauds and bank runs and panics within the economy during the free banking era. The late 1800s. By 1860, thousands of banks were issuing currency. In 1861, the Civil War began, making the situation even worse. In order to finance the Army, the U.S. began issuing paper greenbacks, as they're called. The South issued currency backed by cotton, which was soon seen as worthless. Whenever the Confederates took over a town and began spending their Confederate money, that was a source of great consternation frequently, because people knew pretty well that it wasn't going to be worth anything. There's a greenback there to the right. In order to restore confidence in paper currency, Congress passed the National Banking Acts of 1863 and 1864, giving the government three important powers. One, to charter banks, that means to create them and grant them the right to exist. Two, the power to require banks to hold adequate gold and silver to back up their notes. And 3, the power to issue a single national currency that would stabilize the currency. And this eliminated state currencies and gave the money supply relative stability compared to the past. The gold standard. Gold standard is defined as a monetary system in which paper money and coins are equal to a certain amount of gold. In the 1870s, the U.S. adopted the gold standard, which provided 2 advantages. 1, it established a definite value for the dollar. And 2, the government could only issue dollars if it had gold to back it up, which assured its value. Early 20th century banking. The National Banking Acts required banks to hold enough gold and silver to back up their private notes. In 1907, however, a number of banks failed because they did not have enough gold and silver and could no longer exchange their notes. This led to a nationwide economic panic that caused a loss of jobs, caused a major depression. These were known as bank runs. Therefore, in 1913, Congress passed the Federal Reserve Act, creating the Federal Reserve System. The Federal Reserve System would provide more stability for U.S. currency and the U.S. economy. The Federal Reserve System was the first true central bank and made the following changes. Member banks that belonged to the Fed stored cash reserves at the Federal Reserve Bank in their district, giving them some security. All Federal Reserve banks were supervised by a Federal Reserve Board appointed by the President of the United States. And member banks could receive short-term loans to meet short-term demands, helping to prevent bank failures during a panic. The Federal Reserve System can issue Federal Reserve notes in order to increase or decrease the amount of money in circulation to meet our economy's needs. Banking in the Great Depression. The 1929 stock market crash caused a run on the banks. This and failed loans caused many banks to close. In 1933, Franklin Delano Roosevelt created the Federal Deposit Insurance Corporation, or as it is known, the FDIC. Deposits in member banks are now insured against bank failures. So whenever you put some money into the bank and create an account, I believe you have insurance up to $100,000 on each account. That gives people enough confidence to invest and save money. Modern banking. During the 1970s, the banking industry complained that there were too many regulations and restrictions on lending, which made them less profitable. In the 1980s, therefore, a period of deregulation ensued. Savings and loans, or S&Ls, were small, community-oriented, independent banks that were also deregulated. The S&Ls then issued risky loans and paid high interest rates on member deposits and eventually failed, causing millions of people to lose their deposits. S&Ls were then put under FDIC regulation. In recent years, there has been more deregulation, allowing risky loans that have led to the national mortgage crisis. Basically, people getting huge loans that there is no way they could repay with their income. Banks are tending to merge into larger banks. That is another trend. That concludes our discussion of banking. Thank you for attending, and I look forward to seeing you in the live lesson. Have a great day.